Hi there, this is Alvin from Dr. Wealth, and today's video it's about China because the central bank chief Pan Gongsheng has announced a slew of stimulus plans, and it is the most ambitious, the biggest stimulus plans that China has rolled out since the economic slowdown and the property crisis that has been unfolding in China. So let's digest some of these policy changes as well as what are the cascading effect that we can expect to see from here. So the policy changes were these main 6 points, right? Basically, there were a lot of rate cuts. Okay, cut the short-term rates, cut the long-term rates, cut the bank reserve ratio. They even cut the outstanding mortgage by 0.5%, right? Which is quite unusual because usually when you go and get a mortgage from a bank, it's pretty much fixed, right? Based on the agreement that you guys have beforehand. And if let's say you are not happy, you have to refinance. But in this case, the outstanding mortgage just magically reduced by 0.5%, right? So definitely homeowners will be very happy for this new policy that's coming out. And also for those who are looking to buy a second property, the down payment has reduced from 30% to 15%. So it also become easier for the richer Chinese to buy more properties. Okay, so this is almost like a reverse from a few years ago where they tried to tighten the property rules because of the bubble that's brewing. So after this bubble has burst, now is going aggressive again with this kind of more accommodative real estate policies. Okay, and lastly, this last point, which the central bank has also set up a 300 billion yuan swap facilities for any financial institutions or investment managers who want to borrow money to invest in China stocks. So this is another tranche of stock market boosting policy after the previous one, which the sovereign wealth funds have been buying up the ETFs, right? The national team so-called. So this would probably give a further boost to the Chinese stock market. Okay, so indeed, it is true. After the announcement, the stock indices of various Chinese markets, various segments of the Chinese market has gone up. For example, Hang Seng Index has gone up about 4%. The MSCI China has gone up 5%. Same as CSI 300, which mainly comprises the A shares, and Hang Seng Tech Index was also up 6%. So you can see the response was definitely very bullish. This is not the first time we have seen the Chinese stock market reacting very bullishly, if there's such word, to the policies that China has rolled out. Whether this is going to sustain is also again a question mark. I think there have been quite a few false starts in the past that investors are more cautious, are more wary that this bull run may fizzle out at some point in time. Okay, but I do think that things may be a bit different or getting better and better. All right, things are improving every time new slew of policy is being rolled out, and I'll explain a bit more later. And this is the year-to-date performances. Hang Seng is up about 16.5%. MSCI China is up 13.6%. CSI 300 is not doing so well. It's only up 1.2%. Hang Seng Tech is also not doing so well, up about 5.7%. And the KWEB, which is the Crane Share CSI China Internet ETFs, is up about 15.2%. So those that are listed in the US exchanges are actually doing better. And overall, I would say that it is positive, right? China has been giving negative returns for the past 3 years consecutively. And at the start of this year, I said that this year is likely the year that China will deliver a positive return. And so far, we're nearing the end of the year, it is holding true. And the performance for some of the indices like MSCI China and Hang Seng Index is not bad. It's more than 10%. Okay, although not as good as some other indices around the world. But I do think that coming out from the slump, showing a bit of this result is already commendable. So I would say the recovery is already underway. Of course, we demand more recovery from the Chinese stock market. And I just wanted to add a bit more about Hong Kong, right? Because we can see that Hang Seng actually did very well. Okay, in fact, it's the best performing indices among the Chinese indices, and there are a few reasons why this is so. Okay, actually, there's only one key reason that I believe so, because you have to understand Hong Kong is in a very special situation. Okay? Hong Kong economy is very tied to the mainland China economy, right? Because they are part of the entire ecosystem by geography, by location. They are definitely closer to, or you can say they are part of China, right? Essentially, they are, but they are a special administrative region as of now. So the monetary policy, on the other hand, is very different because Hong Kong dollar is pegged to the US dollar. And in this case, Hong Kong would inherit the interest rates from US. And we all know for the past few years, US have been combating inflation and they've been hiking the rates. Only recently they started to cut the rates. And what is this implication to Hong Kong? Right? So we know that China market or the China economy is slowing down, and China has been cutting interest rate to boost the economy. But Hong Kong cannot afford to do that because of the Hong Kong dollar US dollar pegging. So when US hike their rates, Hong Kong will also have to hike their rates. So when Hong Kong hike their rates, the economy will slump even further. So in the past few years, Hong Kong suffered the most, I would say. Right? At least China, they could still afford to cut rates without that pegging impact. But Hong Kong couldn't. So Hong Kong economy really suffered in the past 3 years. But now it is different because US have started cutting rates of 0.5%. So Hong Kong have started to cut 0.25%. Okay, so in that case, now their monetary policy is aligned, right? So whether is it US policy, China policy, Hong Kong monetary policy is aligned, which is to cut rates, and that is good news for the Hong Kong economy. So I do think that this is a very major inflection point in the macroeconomy policy, and therefore Hong Kong economy as well as the stock market should have a fundamental shift. I will set out a foundation for the bull run in the stock market to happen. Okay, so that is my view. And let's go back to China, right? So another big question that we should ask is, China, why would they want to only give a big stimulus at this point in time? Why don't they do it earlier? Okay, and let this slow economic growth fester for so long, and the real estate slump to sustain for so long. Why don't they do it earlier? Why don't they just cut rates aggressively 1 year, 2 years ago? Why now? And again, I think it's because of the constraint, right? No country set policies alone in isolation to the rest of the world, right? Especially with globalization, a lot of things are connected, and especially with the trade war as well as the geopolitical tension with the US, China definitely will have to make certain decision that is influenced by US policies. So again, it's related to the interest rate in the US, which is high, and that makes US dollar very strong, right? And on the other hand, China has been cutting interest rate, which means renminbi is weakening. And this delta has been widening. And therefore, China could not afford to do a very aggressive rate cut because that will weaken renminbi too much. And what's the implication? The implication would be there will be even more capital outflow from China, right? Because everybody don't want the currency anymore. Currency is devaluing or depreciating, and therefore there will be an outflow of these funds from China, and that will hurt the economy even more. And secondly is that the real estate developers in China has a lot of US denominated debt. And if the renminbi depreciate, that means the US dollar debt would be even more expensive for the real estate developers to repay. So China is hesitant to do a very big stimulus, right? So as not to reduce or depreciate the renminbi too much. So with US cutting rates, US dollar strength will diminish, and now it creates the room for China to go more aggressively. So I think the timing is right. So I think they are waiting for this moment that US is cutting rates, and that has happened. You can see that the central bank has acted very swiftly, right? Just 1 or 2 weeks later, they started with all this slew of policy changes to stimulate the economy as well as the stock market. With all the lowering of interest rates as well as lowering the existing mortgage, right, it should be bad for the China banks, right? Because now the banks will earn less money. And indeed, for the after the announcement, the four major banks did see a drop from 2 to 4% in their share prices, but they quickly recovered back to flat by the end of the day. And how can we read from this is that, yes, fundamentally, these policies would hurt the bank's bottom line, but it could be a case where investors start to think that the policy benefits will outweigh the negativities that is being suffered by the banks. So if China economy recovers, that means that the banks would have more loans, right? They will have more revenue coming from other places. And if the real estate industry recovers, that means that the banks will also have less bad debts and less non-performing loans, and therefore the banks end up better off, right? So I think that in this case, it's a benefit that outweigh the disadvantages. That's why the banks are actually unscathed, right? In fact, at the time of recording, the market is live, and the banks are actually up, okay? So again, it's a sign that the broad recovery is happening in China. And one thing that we should not overlook is also in the commodities market, because China is the biggest manufacturer, it's the factory of the world. And when China economy is believed to be humming along strongly, that means that the demand for raw materials will go up. Okay, they are the largest consumption country for all these commodities, okay, because they take all these raw materials and make stuff for the rest of the world. And we can see that in that one day, zinc, sugar, orange juice, aluminium, copper, these were the ones that saw more than 2% jump. In fact, crude oil was also up 2% after this stimulus policy was being rolled out. So what's the implication of this, right? So again, we need to bring in the US into the picture. So now China wants to stimulate economy, right? Because it's been in slump. That's what we've been talking about so far. In US, on the other hand, has moved out of the inflation risk scenario. Now they are trying to prevent recession and having a soft landing per se. It's not trying to stimulate the economy. The economy is humming along well. It's about 2+% growth, which is pretty much healthy region for the US. But it's more of really worsen, right? So US is trying to cut rates to preempt the potential recessionary pressure that may come later. So both are cutting rates right now. And for commodity prices, as we mentioned just now, right? China, when the economy is strong, when it's growing fast, then the commodity prices will go up due to the higher demand to manufacture goods. And on the other hand, we just know that US had came out from the inflationary pressure. But if commodity prices go up again, US will have this issue that the inflation risk may come back. When inflation risk come back, that means that the US Federal Reserve would not be able to cut rates so aggressively. And when that happens, a US recession may come in because they need to have this balancing act. And nobody knows where that balance is, right? Everybody is guessing, even the Federal Reserve. But there is this risk that may happen, and this China economic recovery may pose a threat to the US actually. So you can see the geopolitical tension is many layers of all this game theory, you can say that. So in fact, if China don't grow that fast, don't use so much commodities, it's good for the US. It makes their policy making a lot easier. Right, so you can say that, yeah, actually that's why US impose all these tariffs, suppress China, so that they don't produce so much anti-dumping policies. So there can be this potential risk, right? So we don't know where we'll go from here. We will have to see, right, how much of the recovery is coming from China and how much of the commodity prices are going up. And that commodity prices is a watch area from now on. And despite the China stock market showing some signs of life, right, we also talked about some false starts in the past. Now, I want to use some technical analysis to draw a picture for you, right, to help you understand the situation a lot better. So now the share price of this MSCI China, right? I use the MSCI China index is because it's the broadest coverage of all the China stocks, regardless where they are listed. And the closing price on 24th September for the MSCI China that's listed in the US, it has gone above the COVID low. You can see the horizontal black line that I draw, right? That was the COVID low. And the yesterday close price has actually go above that. And technical analysis believe that the stock price is only strong if the resistance is broken convincingly. Okay, so at least there is this first sign that is happening. And there's another second sign is that, yes, there were false starts in the past, but you can see that it has pretty much range bound for the past 1+ years, right? The share price is not going much lower, and it has a higher low as well. The lowest low was in October 2022, and there was another low at the start of this year. Okay, at the start of this year, but that low was not lower than the previous low. And again, by technical analysis, that's also a sign that things are improving. And the price is also above the moving averages, which is also another indication that there is some trend change that may be happening, right? Of course, we need to see more highs, right? We need to see these MSCI China surpassing the previous high that was made in, I would say, early 2023, right? Then we can say that the recovery of China stocks have really begun, all right? But nevertheless, I do think that the China stock market is showing some signs of recovery, just as it's very slow, right? Definitely it's not getting worse. People don't like the volatility, definitely, but it's not really getting that as bad as it was in 2022 or in 2023. Okay, so things are looking better, and China investors, China bulls will have to probably wait a bit more, right, to wait for confirmation that the recovery indeed has legs. So to summarize, I would say that the timing is right for China to push out these stimulus policies, and I think that there will be more coming out. Okay, because now with US cutting rates, they are now in alignment, everybody is cutting rates again, that would relieve some pressure on renminbi. Okay, and also important in China is that this top-down resolve to save the market or the stock market is very important. In the earlier period, maybe around 2022, they didn't really care about the stock market. They care about the economy a lot more. And only sometime last year, end of last year, right, the Premier Li Qiang came out, or at the start of this year, I can't remember exactly when, but it's within this 1 year. Premier Li Qiang came out and said that, the stock market needs to be revived, right? And that is a very important, again, a decision that is made top down, because China at the end of the day is a top down country. And if the top don't think that the stock market is worth saving, then nothing will be done. But if the top people and if the top official believe that the stock market is worth saving, a lot of policies and plans will come out to really achieve that aim. Right? So we are at that stage now. We are seeing more of this policy support. So that's why I do think that there should be more good news than bad news. There should be more upside than downside for China equities. And even after all this big jump yesterday or continuing to today, a lot of the valuation remains cheap for China stocks. So many of these stocks, you just pick any one, you do your valuation, it's very high chance that you get undervalued situation. Okay, so it is not too late. And in fact, I would say that it needs more confirmation for the recovery to have legs. We need to see higher highs in the next few weeks or months, and of course sustain that and carry on with that bull in 2025 as well. And there's also a chance that US may go into recession because if the commodity prices going up, inflation coming back, US will not be able to cut rates that much, and the economy may slow down too much. Okay, so there are some risks around the corner, but so far so good. I would say in general, we have seen bull market all around the world, not just in US, China, and the rest of Southeast Asia has done very well, right? Singapore, Malaysia have been making highs this year. So I would say that stay on the long side. I would say that stay on the bull side. That is, of course, always things to worry about. But I think that, again, the upside should be more than the downside at this point in time. And do remember to join our Telegram channel. You get more market updates faster. And I'll keep the link in the description box. You can conveniently just click on it and join our Telegram channel. Also, do like this video and subscribe to the channel, and I'll see you in the next one. Goodbye.